Good morning from our global headquarters in New York. I'm Menace Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set the agenda.
Moynihan's warning, a cautionary note from the Bank of America chief to the Fed.
We got to get back in line. And so they're on that path. They were late to the game. They got to make sure they don't go too hard now. And that's what they are all trying to figure out watching the data.
Consumer woes. Starbucks pulls its guidance for 2025. McDonald's grapples with an E. coli outbreak.
We've taken steps to proactively remove slivered onions, which are used in quarter pounders from restaurants in select states. We also made the decision to temporarily remove the quarter pounder from restaurants in select states.
And bracing for turbulence, Boeing signals a huge loss to come. Can Kelly Ortberg deliver a reboot? Good morning, Manus.
Good morning, Danny. Well, equities this morning are grappling with this trajectory from the bond market. You don't get a real shakedown in equities. They're a bit lighter this morning. Schwartzman says a recession will be avoided regardless of who is president. As I say, it's the bond market that's traveled higher, and you don't trigger a real viable dip until we hit 415 on the twos, according to Julian Emanuel. More from him a little bit later on. Talking about the bond market, there you go. You can see just a tick up by one tick this morning. Again, on the two-year notes, we're up 34 basis points since the Federal Reserve's meeting. And I love the bond market team. They're reflecting on 1995. Treasuries plunged like it's 1995. Let me reflect on 1995. It was the single biggest margin call that I ever had. I hid under a table, and I was like, we'd written puts. We were so bullish on the bond market. We'd written all these puts, and then it didn't go according to plan.
That's fun.
It was massive.
I was 3 years old.
You were 3. I was worried. I was actually worried for my job at that stage.
Very different points in life. Manus, you point out the consumer companies this morning.
Yeah.
Starbucks also plunging by nearly 6%. We're at such an interesting moment for these companies because you could argue it's idiosyncratic. It's a new CEO coming in, but it's not just Starbucks. It's also Nike having the same issues. Aren't we just at a point where consumer companies can't just float along, that they need serious strategy with the end to free money and a consumer that's more picky?
It's the bifurcated consumer. So at the upper end, we know that it's tough times in luxury, but this is the reality of walking in off the street to pick up your Starbucks. Sales down in this country by double digits, down by 10% here, down by 14% in the US. Starbucks on a Saturday morning, I can tell you, it is not a cheap venue to go to. I don't think we can disclose what we buy or how expensive it is.
Are you a Starbucks guy?
I vacillate between Starbucks and Pret a Manger, and Pret a Manger is more expensive than Starbucks.
Okay, we know where you fit on the echelons of the consumer then. Go ahead, Manus.
Well, let's talk about the investors. Okay, you really want to know where we spend our money on a Saturday morning. Investors, they're dialing back their expectations for that rapid reduction in interest rates. The Bank of America CEO cautioned the Fed against being too hasty when he sat down with Bloomberg yesterday. This is what he had to say.
They were late to the game. They got to make sure they don't go too hard now. And that's what they are all trying to figure out watching the data. But whether it's a terminal rate that's the key, and that we think is around 3%. That's a whole different interest rate environment in the U.S. and other markets than it's been in the last 15 years or so. We haven't come close to that level of front-end rate in a long time. And if that's what is done, that's a better place for the U.S. to be, frankly.
A message from Brian Moynihan there to the Fed. Don't go too hard. Our guest this morning is Alfonso Peccatiello, CEO and founder of Macro Compass. Alfonso, thank you so much for being with us. There's Brian Moynihan saying, look, you were late. Don't go too aggressively. And this chimes for you because you say there's a real risk that the Fed may not just pause in November, but pause in November and December. And it is decidedly a tail risk that's hugely underpriced. But how much of a tail risk is a double pause?
I would say, Manus, that it's all pending, of course, on U.S. elections. The double pause by the Fed might only happen if Trump secures a red wave or a sweep, because I think at that point, not only the U.S. economy has proven some, resilience in terms of economic data, but also Trump's policies are undoubtedly pushing nominal growth higher, and also the inflationary part as well. So it might be that, like in 1995, as you mentioned that already, the Fed just goes and then takes a little bit of a pause. And the market is adjusting a tiny bit towards that scenario, but not really pricing it in. In bond markets, you can still figure out structures in option markets where you can get paid about 50 to 1, so a 2% implied probability that the Federal Reserve pauses in November and December. I think that's mispriced. If Trump wins the elections and he secures a red wave, would it be the Fed has some thoughts about pausing and watching for his policies before resuming a cutting cycle again? I think so.
Alfonso, is there some degree where higher yields are just about more volatility? JP Morgan points out that volatility is an important driver of term premium, and there's the expected volatility from regardless of who is president and the more spending. Should we not just command higher yields because of that very fact of volatility?
I think you are perfectly right in the sense that when investors decide to take fixed income exposure, they can do it in a couple of ways. They can buy a 30-year bond, or they can just roll over their T-bill holding for the next 30 years. The two things are very different, though, because a 30-year rate implies 30-year duration risk, interest rate volatility you're exposed to, and therefore you're going to be demanding a term premium or a compensation for that volatility. Now, the higher the volatility that you expect in the growth and inflation cycle, the higher your term premium. I think Trump's policies add to the term premium more than Harris's policies. But in general, yes, you're right in the sense that the more fiscal deficits that are pro-cyclical rather than anti-cyclical, permanent fiscal deficits, the more likely it is that term premium should be higher in this cycle.
Well, just speaking about term premium, and Danny and I have looked at this a couple of times, but you would actually say there's not enough term premium out there for the scale of fiscal policy from either side coming through to next year. So how does that reflect in terms of the bond market, the curve shape?
So the term premium is expressed mostly at the long end, man. It's simply because the longer your bond, the longer your duration, relatively speaking, the more you're exposed to interest rate risk and interest rate volatility, which means you're more exposed to this rapid fluctuation in inflation and growth cycles. So normally speaking, term premium gets reflected at the long end, so that ceteris paribus means long end yields should be higher. Of course, I always invite people to reflect on the fact that long end yields are also a function of demand and supply, and they're also a function of the current economic cycle. But you're perfectly right. Term premium should be higher, I think, to reflect the fact that the U.S. is now applying some sort of permanent fiscal deficit policy.
Alfonso, the other asset class you see is mispriced is FX. You write that it seems unprepared for the vicious moves that could come after the election. What sort of vicious moves are you expecting?
Well, I think that the Trump trades, the standard ones, are now pretty crowded. If you look at the skew in bond markets, as we discussed, I mean, people are preparing for a move higher in rates. If you look at banks, they're outperforming as a sector, and Trump's deregulation helps. But in certain currency markets, that's not the case. So, for example, Trump has discussed about reviewing the USMCA deal, which is Mexico and Canada. And so while the Mexican peso has been a bit rocky lately, the Canadian dollar not really. So if you look at option markets, you can get exposure to a downside move in the Canadian dollar, which reflects, again, the renegotiation of Trump's policies, but also the Canadian economy is actually suffering from higher interest rates. Well, those puts or downside expressions on the Canadian dollar are really not expensive. And the other place to look at is Europe, of course, because Trump is also maybe voicing out some ideas of forcing Europe to spend up for defense and reviewing the NATO deal, basically. That is also going to force Europe to spend more, which might be another reason why the euro has a little bit of a downside. In both cases, Canadian dollar and euro, these expressions are not as expensive as a hedge to put up.
Okay, it's going to be an interesting time in less than 2 weeks. Alfonso, thanks for setting it up for us. Alfonso Peccatiello of Macro Compass. Let's get to some other top stories now that are trending on your terminal this morning. Deutsche Bank plans to restart share buybacks. Revenue with investment bank rose, and the lender largely settled a legacy dispute. Bloomberg spoke to the CFO about possible consolidation.
We're always looking at our option set, as any sort of well-managed company should. And domestic consolidation is clearly on the list of things that you would look at as you observe your option set. We've been, I think, pretty consistent in saying the industrial logic for bank mergers makes sense, but that we needed time to be fully ready, and that time hasn't come.
The CDC says a severe E. coli outbreak tied to McDonald's Quarter Pounder has sickened dozens of people and killed one person in the United States. The company said it was taking swift and decisive action to control the outbreak and remove the Quarter Pounder from restaurants in the affected areas.
Boeing is signaling that it will report a huge loss when it announces third quarter earnings before the bell today. It puts a spotlight on the new CEO Kelly Ortberg's plan to fix the troubled plane maker. Investors or analysts are looking out for Ortberg to lay out his strategy during his debut earnings call. Coming up, 13 days until the American election. The candidates are blitzing the swing states. We're going to bring you the latest.
And later this on, Julian Emanuel from Evercore joins us around the desk to discuss his outlook and the risks for election 2024 for markets.
worked at McDonald's when she was in college to pay her expenses. She did not pretend to work at McDonald's when it was closed. And she is as prepared as any nominee for president has ever been. That's who Kamala is.
I don't think anyone wants an America where people are worried about retribution or what people will do if you make your opinion known. I think Vice President Harris supports a future for this country where these freedoms and many others will be protected and upheld.
That was rapper Eminem teaming up with former President Barack Obama at a Kamala Harris rally in Detroit, Michigan. Donald Trump called the former president a jerk as he courted voters at a rally in North Carolina. Harris, meanwhile, gave an interview to NBC, skipping the trail for the day. Joining us for the latest on the race is Bloomberg government reporter Courtney Rosen in Washington, D.C. Courtney, if we had been talking last month and we said that Harris wasn't on the trail, instead she was doing a media blitz, people probably wouldn't have believed it. She got a lot of questions about how to distinguish herself from Biden. How is she coming across in her media blitz?
She is appearing on lots of different media with different audiences, talking to journalists like NBC, like you were talking about, and also appearing on podcasts with different audiences. She's appearing pretty consistent throughout them. And it's interesting because we haven't seen her do as much media during her time as vice president. It's really been amped up in the last couple of weeks, and it's given journalists and just the public the opportunity to ask questions.
Well, certainly Donald Trump was taking a pop at her yesterday in terms of being in Washington rather than being on the campaign trail. He was reaching out to Latino voters, but at the same time, he's also agreed to go on Joe Rogan's podcast. Joe Rogan didn't want him on his podcast for a couple of years, so this is a meeting of minds. What kind of audience is he going to get out of this podcast? Because it's a significant reach.
Young men. And that's what President Trump and Vice President Harris are trying to target right now, or one of the demographics that they're hoping to turn out. Joe Rogan is widely considered one of the most popular podcasters in the country. His audience is massive. And so when you're trying to court that particular demographic, that's where you go.
Courtney, just again, 13 days away, and everybody says, okay, is there going to be some sort of October surprise? A lot of people on the internet had a frenzy about this New York Times report from John Kelly, Trump's longest serving chief of staff. Let me just read some of the quotes that John Kelly said. It's a very dangerous thing to have the wrong person elected to high office. He, being Trump, commented more than once, you know, Hitler did some good things too. Obviously shocking statements, but does it cut through the noise at all at this point, so close to the election?
It remains to be seen. John Kelly's comments track with what we've heard from past Trump administration officials, aides that have worked close with the president. It's not unusual to hear these kinds of comments from a former staffer, right? It's something that the Harris campaign has been trying to highlight. Republicans in general that are breaking with the former president and are going to vote for Kamala Harris. One prominent example is Liz Cheney, the former congresswoman from, former congresswoman, good morning, it's early, who is appearing with Vice President Harris on the campaign trail pretty frequently in areas with Republican strongholds, trying to convince voters to what she calls vote your conscience and break with the former president this election.
Okay, well, some pretty strong language in that article in the New York Times. Courtney, thank you very much. Courtney Rosen there.
Thanks for having me.
The trail as we count down to election 2024. Coming up on the show, skipping the lattes, how Starbucks is handling the steepest sales drop in 4 years. Context matters on Bloomberg. Bloomberg Brief. I'm Menace Graney alongside Danny Berger here in New York. Front pages, this is what we've got Headlines from around the world. We'll kick off with the Journal. Frontier Airlines exploring a renewed bid for Spirit Airlines. And if the deal comes together, the two carriers, well, it would likely happen as part of Spirit's restructuring its debt and other liabilities in its bankruptcy. Frontier and Spirit have been circling one another, quite literally, on and off merger since 2016. Will it happen?
I don't think planes are supposed to be circling each other. I think that's dangerous. Yeah.
That's what traffic control is for. That's what the producer's for in our ear.
Right. Next up, Bloomberg has this, leading with Starbucks pulling its guidance for 2025 after a sales plunge for a third consecutive quarter. The coffee chain reported a 7% decline in same-store sales. There was weakness evident in the U.S. Companies said basically that this will give the CEO, Brian Niccol, time to figure out a turnaround plan, Manus.
And the New York Times leads with Bill Gates privately saying that he recently donated $50 million to back Vice President Kamala Harris. Now, Gates said in a statement to the Times that this election is different. He made the donation to Future Forward, which is the main outside fundraising group supporting Harris.
Let's talk a little bit about private capital, shall we? Because it has been a difficult market for gathering new money. Even with that, though, EQT, one of the biggest private equity funds in the world, exceeded its target this year and is looking to take away competition. I caught up with the chairman, Connie Janssen, at their Capital Markets Day yesterday.
There is sort of a lot of discussions about we are consolidating certain industries and taking away competition. Typical FTC thing, and they should be looking at it. Of course, they're doing their job, but we should be sensitive. And when we do these kinds of things, we should not sort of misuse the power we have. And you have case after case after case where we have done so, and that's also part of the transformation that we are part of. But we should be a bit more sensitive, I think, to us going too far too fast. Because it will create a negative connotation around this industry, completely unnecessarily, because there is no reason why it should be that way.
I could argue that it's gone pretty far, pretty fast already.
Yeah, and I don't really see any turn in sight, and that's pretty sad.
That is. Shall we talk about something a little bit more, maybe not more joyful? But I do want to ask about this current environment, because again, 30 years you've invested through some different cycles. There's going to be young people coming up in this industry who haven't invested in different cycles. There are people who've never seen high interest rates before, and they've never seen what at least seems to now be a cutting cycle and embarking in a different interest rate. I wonder what you think of the preparedness for this industry as we kind of waffle between expectations of cuts, of easing, of potentially more tightening, of potentially more inflation, just this very volatile macro environment. How prepared is it, and how do you see sort of EQT navigating that macro environment?
I think the macro risks we have been dealing with all the time. But it's always so that when you are in something, what you feel it's there now, it's completely new, it's scary, it's risky. But looking back to the 30 years we have been operating, we have been through a lot of different things. We had the pandemic not too many years ago. Everybody thought that the world was supposed to go out of business. We managed that. We're here now. So I think that the cyclicality and the overshooting and the stupid thing with no interest rates and with the correction back to some kind of normal stage, I think those things we can manage. I think the risk that I'm most concerned about are the geopolitical risks right now. Because you can easily paint a very negative geopolitical scenario. And in such a scenario where the whole logic for trade, for international cooperation, if that goes away, goes back to where we came from, those risks, I would say, is more severe and difficult for us to manage than all the other things. I think we can manage all the other things.
My conversation with the EQT chairman, Connie Janssen. Look, it was supposed to be an event where they were really excited about their growth, but it was hard to come away from that conversation and not feel a bit dour. Not only was he talking about geopolitical risk, he really felt it acutely that something more is happening with hot wars popping up throughout the world. And this is what the industry really has to worry about. Who cares about higher for longer rates?
Well, as you and I were just chatting about this, they've weathered 500 basis points of hikes. They've weathered a war in Ukraine, Russia. The question then becomes, where's the next significant hot conflict? And you have this morphing of grey grey event risk and black swan risk, and the things begin to shift and change, don't they?
Right. And the other thing he also talked about in the kind of beginning of that clip was really critical about the industry just being in asset gathering mode.
Yeah.
And basically, when you do that, it leads to more regulation, and they're overlooking that.
But then is the risk that regulators come and stop you from growing, or that they come and actually perhaps break your... I mean, look at what the regulators are doing with big tech at the moment, and you can certainly say PE and asset gatherers are vast in their size. So the risk is, what, break up or just stymieing their growth?
Well, I think it could be either, and I think the political environment is such that it doesn't matter who's in the White House. The trajectory is clear for regulators that they're not liking these big businesses, and if you're a Blackstone and you're trying to do everything to everybody, EQT says, watch out, they're coming for you.
They're coming for you. Well, I'll tell you what, it does matter who's in the White House, and especially for the dollar. I mean, the muscle exercise that dollar yen is getting. And this just shows you, nobody really knows where we're going to end up. The polls versus the betting markets are very different. Look at dollar yen. This is breaking through the 200-day average, and you got bonds in Japan, Danny, breaking through a 40-year high at 2.53. That's doing nothing to help the yen at the moment.
It wasn't that long ago that everybody was saying, get long the yen. They're going to be hikes from Bank of Japan. King dollar, though, comes to reassert itself. Yen this morning weaker by more than 1%. This is Bloomberg. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manish Krani. Let's set your agenda.
Moynihan's warning, a cautionary note from the Bank of America chief to the Fed.
So we got to get back in line. And so they're on that path. They were late to the game. They got to make sure they don't go too hard now. And that's what they are all trying to figure out watching the data.
Consumer woes. Starbucks pulls its guidance for 2025. McDonald's grapples with an E. coli outbreak.
We've taken steps to proactively remove slivered onions, which are used in quarter pounders, from restaurants in select states. We also made the decision to temporarily remove the quarter pounder from restaurants in select states.
And bracing for turbulence, Boeing signals huge losses to come. Can Kelly Ortberg deliver a reboot? Danny, good morning.
It is a busy day for individual companies. You point out there, maybe that's what's dictating the direction of this market. Starbucks, McDonald's, all getting hammered overnight for the reasons that you mentioned. Tesla, Boeing, Coca-Cola, all on deck. S&P 500 futures lower by 1/10. Russell 2000 lead the market lower yet again. Maybe small caps are doing worse because of this. The bond market yields continue to be under pressure. You had the great statistic, Manis. What is it? 34 basis points higher in your two-year yield since the Fed decision. We're up about 2 bips for the 10-year yield, 4.2. We were showing you yen on the bottom of your screen there, declining more than 1% versus the dollar. Manis, it is right now a market that it's difficult to disaggregate. How much of this is about strong data? Is it about the Fed maybe not getting all the cuts they want, and the so-called Trump trade?
Yeah, I think it's a mixing bowl of all of it. If you look at the musculature of the rates market, that is the alpha for the dollar. And that dollar-yen trade, I mean, just 5 weeks ago, everybody was talking about 140, 130, and all the way down. Now it's above 150. How much of that is carry trade? How much of that is dollar? Today, we're going to talk to Julian Emanuel, and I think it's fascinating. He's talking about the trigger point for these equities. Is 415 on the twos. That's when you get a bit of a shake of the tree and you get in there and buy.
Well, so many people said the Trump trade, it's going to be great for small caps. Look at what small caps have done over the past couple of days. They are my favorite, and they consistently suffer. Small caps have not done well. Is that a flavor of the Trump trade? I'm interested to ask Julian about that. Stay tuned for that conversation in about 10 minutes' time. In the meantime, Manis, we have some companies to get through. ARM turning on Qualcomm. The UK chip maker gave its longtime partner a 60-day notice of canceling its design license. ARM had sued Qualcomm for breach of contract back in 2022. Joining us now is Bloomberg Intelligence litigation analyst Tamlin Basin. Tamlin, how did we even get here? What's the story behind this?
Right. Well, so the story behind this is we got here because Qualcomm decided to purchase Nuvia back in 2021. Now, after that happened, ARM did terminate its license that it had with Nuvia, and then it later sued Qualcomm, saying even the chips that were designed when Nuvia had that license, you're not allowed to continue building on those. So they filed a suit. That suit is going to trial, it's scheduled for trial in mid-December, incidentally right around when the 60-day deadline is about to expire. That's how we basically got here.
It's interesting. I'm just looking at some of the analyst notes here. JP Morgan say, well, the license cancellation marks an escalation in the disagreement between the firms. An eventual settlement is the most likely outcome. But in terms of negotiating that, what is the impact in the interim period of time? What's the worst kind of scenario, the worst case scenario financially in terms of an impact?
Right. Well, I think the worst case scenario would be if ARM actually was able to terminate this license. This wouldn't be just an impact for Qualcomm. This would roil the entire sort of chip industry. We do think that this is probably more or less a tactic to try to gain leverage and get that new license agreement with Qualcomm that would probably be at a higher rate than what Nuvia was paying ARM. But yeah, this is a much intensification of the ongoing dispute, and it really is kind of a nuclear option for ARM to try to terminate this license.
Okay, they're hitting the nuclear option button. Let's see where it goes to. Tamlin, thank you so much. Tamlin Boson, Bason of Bloomberg Intelligence. Now, the stock that we're tracking this morning is McDonald's. We've been telling you they've a severe E. coli outbreak. It's tied to the restaurant chain's Quarter Pounder. It made dozens of people sick, and it has killed one person in the US. That's according to the CDC. Now, McDonald's has pulled the signature menu from select states.
The decision to do this is not one we take lightly, and it was made in close consultation with the CDC. It's important to note that the majority of states and the majority of menu items are not affected. Other beef products at McDonald's, including the cheeseburger, hamburger, Big Mac, McDouble, and the double cheeseburger, are not impacted.
Eric Vanner is tracking this story for us. Eric, at this stage, it looks like McDonald's response has been swift. It's been aggressive, 49 cases in 10 states. Is it contained? That's, I suppose, the step one question, isn't it?
Yeah, that's right. I mean, it seems like what they're saying at this point is this is something that's limited to one product, slivered onions, they've said, from one supplier that served a couple different distribution centers. It's focused on kind of the Midwest and mountain states in the U.S. So obviously a fairly widespread area, but it doesn't seem at this point like it's spread to other products or other regions, certainly not over here in Europe where we're based. But yeah, something that, has obviously affected a large number of people already.
Eric, it was also a post-tough market session for Starbucks. It pulled its guidance for next year with the new CEO incoming. When Brian Nichols was announced as the new CEO, the stock itself rallied 24%. Is this a moment of pause? What does it tell us about how long Starbucks needs to have this transformation take place?
Yeah, there's probably an element here of, kitchen sinking or clearing the decks, whatever you want to call it. When a new CEO comes in, they want to clear the slate, give them a better base to build on. But it does, it highlights just the fundamental nature of the problems there. A sense that they've lost their focus. They've gone into too many different areas, gotten away from, just being a solid coffee chain, doing all these things for all people. And that, at a certain point, it just has stopped working, right? And so now they have to clear the decks there and get back to basics seems to be the prescription.
Eric, appreciate it. That is Bloomberg's Eric Vanner. All right, we're also watching Boeing this morning. Boeing announces its third quarter earnings before the U.S. market opens. Little change so far pre-market. Investors and analysts are looking for the new CEO to lay out his strategy during his debut earnings call. Also today, union workers will be voting on whether or not to end their strike. Bloomberg's Benny Camel leads our global aviation coverage and joins us now. Benny, let's start with the earnings. What are you going to be focused on?
So the focus really will be on the messaging from the CEO, from Kelly Ortberg. He's been in the job for just a couple of months now, and it's been a really tough job for him. A lot of things to contend with. We know some of the numbers already. They came out with some preliminary data a couple of weeks ago when they announced some job cuts. So we know that sales fell short. We know they're going to have big charges. We know there's going to be another outflow of cash. So that's going to be less of the focus, more sort of in the messaging from Kelly Ortberg, sort of how does he reboot this company? And it needs rebooting on the product side. It needs rebooting on the financial side. It needs rebooting in terms of the relationship between sort of upstairs and downstairs, sort of the management and the factory worker. So all these areas are sort of sticking points for him that he needs to address. He'll come out with a memo to employees and to investors. So that will be very closely poured over. He'll also appear on a conference call. So that's really going to be the focus. And then, as you said, later in the day, we will get this crucial vote from workers. And which way it'll go, it's really too early and too difficult to say at this point.
Benny, good morning to you. They've taken remedial action. They've shored up the financial lifeline. The backstop is there to give him the breathing room to really look at how do you restructure Boeing fit for purpose in the future. And part of that is going to be trimming back what Boeing is, and that's about asset sales.
Absolutely. And that's something that he did say a couple of weeks ago, and I imagine that's something he'll be quizzed on today. What will Boeing look like in the next year and beyond, in 5 years? Everyone said Boeing is too big to fail. They're not going to go away. But this is not a company that's too big to fade. This is a company that could sort of fade into the darkness and others take over. So that's something that he will want to prevent. And to do that, he needs to focus on what is this company good at? Where can we put our resources? What is our focus? We can't be everything to everyone, and they need to think about building the next aircraft. People will be looking for any commentary on that. When might that happen? What kind of resources might be allocated to that? So that will really be sort of the crucial part, sort of how do you map out a future for this company that's really been in crisis for the better part of this year.
Benny, part of the crisis, though, had been this criticism that the former CEO and management didn't know what was happening on the floor. It's been a contentious negotiation over these strikes, over pay deals. Where does it leave just the company in itself and the ability to have this morale and understand what day-to-day workers are doing at Boeing?
Yeah, so morale is a big sticking point again for Ortberg, and he's made sort of the right noises since taking over. He's moved his home to Seattle. He's on the factory floor, so they've distributed photos of Kelly Ortberg sort of walking the factory floor, talking to people, touring the sites. So he's made a big point of that, to be close to the action, to listen to workers, and to overcome this divide that long existed between sort of the Boeing senior management that was sort of fixated with the financial returns and the people on the ground building the planes, and one side didn't know what the other was doing, and the demands from the top weren't clearly distributed at the bottom. He wants to get through that, but of course, in order to do that, he needs to get that relationship fixed. And right now, the relationship is broken. The workers are striking. They've turned down 2 agreements already. And if they turn down the third one, it will show just how deep that divide is. But if they can fix it, if they can vote to ratify this accord today, it will go a long way towards healing those relationships. And that really is a crucial stepping stone for him to get the company back on track.
Benny, appreciate it. That is Bloomberg's Benedict Campbell, who leads our global aviation coverage. Those earnings to come before the bell. Coming up, the S&P 500 just broke its longest winning streak since 1955. We're going to dive into the equity market next. Julian Emanuel of Evercore joins us on set here on your Bloomberg Brief. You're watching Bloomberg Brief. Danny Berger and Manus Cranny in New York. The S&P 500, after yesterday, just saw back-to-back down days. It hadn't done that, though, in 31 days. That is the longest streak for this equity market since 1955. Joining us now is a man who has a 6,000 price target on the S&P 500. It is Julian Emanuel, Chief Equity and Quantitative Strategist at Evercore ISI. Julian, great to see you. Thanks for coming in so early this morning.
Great to be here.
So you put out a great note just moments ago this morning. I actually don't know how you did that because you're standing in front of us right now.
Magic.
Technology. Technology.
You point out that the bond market volatility has really injected something into this equity market, and perhaps is the reason we've seen those 2 days of back-to-back declines. Just how sensitive are we right now to the bond market and a lot of event risk coming up in the next few weeks?
So it's really about the element of surprise. Okay, we know there's an event on November the 5th that by all rights is going to deliver surprise one way or the other, contested, uncontested, divided or unified. But the real surprise is that if you go back to September 18th, when the Fed cut 50 basis points, 10-year yields are up 60 basis points and 2-year yields are up 40 basis points. And the fact is that what really has happened is that was a ratification of the soft landing. You've also, at the confluence of the fact that both candidates' policies are likely going to increase the budget deficit and perhaps cause inflation to continue declining at a slower rate or even stabilize. And so putting all that together, it's no surprise that we're experiencing a little bit of volatility, particularly since stocks are trading at 24 times earnings.
I mean, you warn about, there's a lovely line in this from James Carville, who of course masterminded a lot of the election triumphs. And you talk about the bond market, you can intimidate everybody. But for you, 2-year notes have got to get to around 415 before it really begins to show some flex in really intimidating this market, this equity market.
Yeah, and because of the sort of, I wouldn't call it binary, but the multivariate nature of what could happen after the election, it is certainly possible that the markets decide to ignore the fact that rates have continued to rise, and you get into sort of a melt-up scenario. And we suggest that if, in fact, the election is, quote unquote, clean and uncontested, whoever wins, that's sort of how you get into the melt-up scenario. But the sort of countervail to that is if it's a messy period, sort of how the election came out in 2000 with the sort of hanging chads, that's where the focus on the fact that interest rates have risen as they have could put pressure on the market.
But would a clean outcome with a red sweep not do something similar, just in the idea that the deficit's going to swell a lot more than it would under a divided Congress or a blue sweep, and higher yields then pressure equities? You think even in that scenario, equities can do okay?
Well, longer term, that's certainly a possibility. But when you think about the dynamics of 2024 in particular, it's been a very good year for stocks, as we all know. And the work that we put out around Labor Day showed that actually in presidential election years where the markets were up double digits on Labor Day, you finished higher on December 31st, 6 times out of 6. So I would suggest that if, in fact, you got the red sweep, there'd probably be just a relief that there was a known and decisive outcome, and that would, in all likelihood, trigger sort of a performance chase that we sometimes see from hedge funds coming into year-end, which is positive seasonally 8.5 to 9 times out of 10 anyway.
Look, the betting markets are saying one thing, and we know that there's a skew in the betting markets, but the polls are not showing a real probability of a red sweep at the moment, which then takes us back to the sort of chaos theory that you put forward. And you look back at Al Gore in 2000, you talk about these hanging chads. The market dropped by 12%, then bond yields spiked by 100 basis points. Should we have a base case of contest and quasi-chaos after this election? Because the litigation's already started.
I don't think it's a base case by any means. It is certainly, a reasonable probability in the, really plethora of scenarios. And it's part of, so what we've done, we have that 6,000 price target, but what we actually did was rejigger it based on the probabilities we assigned: red sweep, blue sweep, divided, contested, uncontested. And actually what we found was the sum of those probabilities get us to 60-70. Only what's happened is because the market's advanced so much over the last several weeks, you've created a greater degree of risk for either those tail outcomes, a decisive result, or the downside of a contested result.
We've basically spent 5 minutes without even talking about earnings so far here in the start of earnings season. Shall we get into it? I want to talk about the consumer companies specifically because they have these idiosyncratic problems. McDonald's certainly idiosyncratic, Starbucks, but it's the same story at Nike, a new CEO. How much do you look at these things and say these are one-off, or this is a wider problem with consumer companies that are sensitive, that are struggling, and the sector as a whole is challenged?
Well, there is an element of one-off, but the backdrop to a lot of this has been what has been the prolonged weakness in China. And that's filtering to a lot of these multinational companies. And that is something that, I think is part of what the policy response has been in China in recent weeks, and which is why we're actually optimistic looking to 2025, not only on China equities, but the companies selling into China. And so, again, the backdrop is the labor market is good, the consumer is still good. The holiday selling season looks, by all rights, particularly if you think about it from a stock market barometer, is going to be good as well. It's not gangbusters, but it's solid, which is what we need at this point in the cycle.
I like how you described financials last week. They were triumphant. We get ready for Mag 7. Part of the narrative, NVIDIA made another record high just the other day. So there's a lack of jangling of nerves around NVIDIA. As you prepare for Mag 7, what is it that you expect? We still expect high double-digit growth, but that's a taming of the earnings outlook. How prepared are you for Mag 7?
Well, and we're going to find out, when we hear from one of those companies later this afternoon. But next week is clearly the critical week. The issue here is we know the earnings are going to be good.
Yeah.
These companies tend not to disappoint. But has the interest rate market moved far enough such that high multiple, long duration stocks like these companies, where the earnings reaction will be muted or even perverse given what we've seen in interest rates? We don't think we're quite there yet, so we do think the focus will be on what the actual results are. But again, at this time of year, and then we made it through those first 5 minutes without talking about earnings, it just shows there's a lot of noise in the markets.
Yeah. What's your trigger point? When does it disrupt? When do rates disrupt the market?
So we're looking at the 2-year yield moving above 415 as the point where I think people will start to get uncomfortable.
Great. Well, let's count down to Tesla. I'm still faithful to all the coffee shops all around New York. Julian, thank you very much.
Thank you.
Julian Emanuel there of Evercore, our guest this morning. Coming up in the show with Danny and myself, we'll set you up for the trading day. The beige book, I know they get excited about that on surveillance because context matters every day.
It's Bloomberg Brief, Danny Berger and Manish Cranny in New York. Let's set you up for your trading day ahead. We're going to get a lot of earnings. Boeing, Coca-Cola, Hilton, they come before the bell. And then we're going to get one of the Mag 7, Tesla, that after the market closed. We also hear again from ECB President Christine Lagarde and BOE Governor Andrew Bailey, plus the BOJ Governor Ueda. That all happens throughout the day. Plus, the Fed will be releasing its beige book at 2 p.m. Eastern. The Fed perhaps more carefully looking at anecdotal evidence this time around, Manis.
Danny, we've got some micro movers to keep an eye on. This is what we've got for you. At McDonald's, we've been tracking this story through the morning. This is the quarter pounders been taken off the market. It's linked to E. coli, so it's been taken off the market in certain districts. Dozens of people have become ill in Colorado and Nebraska, and one person has died. Starbucks down 5.4%. They're suspending the 2025 guidance. Another sales slump here in the United States of America and in China. And Texas Instruments bid up by nearly 4%, extending the post-earnings gains. Nice beat on the results, overshadowed by a disappointing outlook. So that's the state of play on those. Danny?
Yep, certainly earnings in focus. Julian Emanuel says that the consumer companies can come back with China's stimulus. Let's just take you out on a look at currencies this morning. Yen weaker by about 1% versus the dollar. Surveillance will take it from here.